So something pretty dramatic just happened in the Bitcoin market. We're talking about a high-stakes battle with billions of dollars on the line. The forces of belief and pure skepticism are clashing like never before, and we're going to break down exactly what went down.
First, we'll look at the absolutely shocking price surge that kicked this whole thing off. Then, we're going to demystify the short squeeze. That's the wild market mechanic behind all the chaos. After that, we'll explore the big players on both sides of the bet, touch on a really surprising vote in Washington, and finally, we'll put all the pieces together to figure out what signal the market is actually sending.
All right, so it all started right here. A sudden, explosive move in Bitcoin's price that sent these massive ripple effects across the entire crypto world.
Okay, so get this. Bitcoin just rocketed up, surging towards a staggering $73,000. Now, for an asset this big, a move that fast is a huge deal, and it caught a ton of traders completely off guard. But the real story here isn't just how high the price went, it's who got financially crushed on the way up.
And this is the other side of that coin. For every person celebrating that surge, there were others who had bet a ton of money that the price would go down. And when it skyrocketed instead, they didn't just lose a little, they got totally wiped out. This massive loss is the key to understanding everything that happened next.
So how exactly did those traders get wiped out? Well, to get it, we need to understand a really powerful market event called a short squeeze. So let's break down what that actually is.
First off, you got to know what short selling is. It's basically a bet that something is going to fail. A trader borrows an asset, in this case, Bitcoin, and they sell it immediately. The whole game plan is to wait for the price to drop, buy that Bitcoin back at the new, lower price, return it to whoever they borrowed it from, and then pocket the difference. Sounds pretty simple when it works, right?
But what happens when it goes horribly wrong? Let's walk through it. Step 1, traders bet on a fall. They short Bitcoin. Step 2, the unexpected happens. The price doesn't fall, it skyrockets. And this is where the squeeze kicks in. Those traders are now losing money like crazy, and they're forced to buy Bitcoin at a high price just to stop the bleeding. And here's the kicker, all of that forced buying creates even more demand, which pushes the price even higher, squeezing all the other short sellers even harder. It's just this brutal, vicious cycle.
So what you have is this classic market battle, the bulls versus the bears. Bulls, of course, are betting the price goes up. The bears are betting it goes down. And in this recent showdown, the bulls scored a massive, decisive knockout.
You know, this battle isn't just happening on trading screens. The divide over Bitcoin runs incredibly deep, from the biggest financial institutions right into the halls of government. And you can really see the skepticism from some people. I mean, even with Bitcoin near its all-time high, you've got a strategist from a major outlet like Bloomberg predicting a crash all the way down to $10,000. That's a massive disconnect from where things are today. And yet, while some are out there predicting doom and gloom, the big money is telling a totally different story. The source material for this explainer says that major institutions are quietly buying billions of dollars worth of Bitcoin. They're not shouting about it, but believe me, their actions are speaking way louder than words.
And the doubt isn't just financial, it's political too. There are really influential politicians out there who are publicly dismissing Bitcoin, even calling it a Ponzi scheme. This just adds another layer of risk and uncertainty. So you see the conflict, right? You've got these loud public critics, but at the same time, these quiet, massive buyers.
Okay, now, while all this market drama was playing out, a totally separate event happened in Washington that could have huge implications for the future of digital money.
So the U.S. Senate held a vote on preventing the government from creating its own central bank digital dollar, or a CBDC. And the result? Wow, it was not even close. An overwhelming 89-10 vote against it. I mean, that is a powerful, bipartisan statement.
So you're probably asking yourself, okay, why should a Bitcoin holder care about this vote? Well, think about it. A government-backed digital dollar would be a major, centralized competitor to a decentralized asset like Bitcoin. Taking that option off the table, at least for right now, really changes the competitive landscape.
So let's recap. We have all these conflicting pieces: a massive price surge, a brutal short squeeze, public skepticism, quiet institutional buying, and a key political vote. So what does it all mean when you put it all together?
The source material suggests that when you line up all the evidence, the signals are all pointing in a pretty bullish direction. First, that short squeeze was a powerful liquidation of anyone betting against Bitcoin. Second, you've got large institutions quietly accumulating it. And third, a major potential competitor just hit a huge political roadblock.
And this brings us to the main takeaway from our source.
Combining all these events sends a clear signal, and you better believe the smart money in the market is paying very close attention.
So for now, the bulls are definitely in control, and the dares have been silenced. But the bigger war, the one between the skeptics and the believers, that is far from over. And that leaves us with the ultimate question. In the long-term battle for the future of money, who is going to be right in the end?